Tom, really good to see you. Today we are talking about 3 RMD strategies to reduce your tax burden. I know that you're always thinking of strategies to help your clients reduce their taxes. So let's talk about those required minimum distributions because proper planning is vitally important.
Of
And let's
course.
start at the top. What are RMDs and how are they calculated?
So RMD stands for required minimum distribution. And that's the point in time in your retirement for most people when the government is telling you that you have to start taking money out of those qualified accounts, IRAs, 401ks, 403bs, 457, any type of account that you haven't paid tax on for your contribution. And now it's the government saying you're 72, time for you to start taking that out so we can start charging you some income tax on that and start getting some of our money back.
And here's how they're calculated. Explain what's going on here.
Right. So what the government does is they have a set factor based on your age. It's based on your life expectancy, and you take that factor and you take your prior year year-ending balance. So your December 30 for this year, it would be your December 31st, 2021 account balance. You divide it by that factor, and that's what your RMD is. If you're 72, that first one is about 4% of the account value, and then each year it increases a little bit by your age.
And I know that you work really hard to make sure that your clients take those distributions when they need to, because if they don't, there is a very significant penalty.
Sure. If you don't take it by the end of the year, then there's a 50% penalty on either what you were supposed to take out or what you missed taking out if you only did a partial. It's the largest penalty in the Internal Revenue Code. So the government is very serious about you taking those out. Because there was some confusion because of the Secure Act, the IRS has waived the penalty for under certain circumstances for 2021 and 2022. But again, that doesn't negate anybody from having to take those distributions. Particularly what they did were for the beneficiary IRAs, where there was a lot of confusion about who and when they had to take those.
So now let's run through then 3 strategies to reduce the tax burden that comes with those RMDs. And first on your list of considerations, early distributions. Why is that?
Well, at 59 and a half, you can start taking distributions without a tax penalty, right? It's not an early distribution anymore. Under certain circumstances, you can go as early as 55, but there's just a few exceptions for that. But at 59 and a half, you can start now taking some of those distributions. They're taxable, obviously, because they're in a IRA or qualified account. But it's a way to perhaps start getting money out of those accounts today while we're in a lower tax environment. Most people, including myself, think that taxes will only be higher in the future. And we know they will be in 2026 if the government does nothing.
So speaking of that, let's just take a look at historical tax rates here while we bring up your next strategy, which is Roth Conversions.
Right. Roth Conversions is a great idea. I use it for almost everybody. Right now, we're in a lower tax environment. Again, we know in 2026, the tax changes from 2017 will fade out. And so we are going to be in a higher tax environment if the government does nothing, which, again, they're very good at. Now, that chart, one of the things in that chart that people should be aware of is that average from 1913 to 2020, the average highest tax rate is 58% on average. And throughout the decade of the 70s, for the whole decade, the highest tax rate was 70%. And so we all know that everything moves towards its average. So over time, with all the spending the government has been doing over the last 3, 4, 5, 6 years, especially, we know that those tax rates are going higher. The government, the Congressional Budget Office is telling us they are, and the government is telling us that they are.
And the third strategy to consider here, qualified charitable distributions. I like these because they really are a win-win for everybody.
Yeah, there's a couple of things you have to be aware of. One, you have to be at least 70 to be able to do it. Two, and I think maybe most importantly, is that you cannot take constructive receipt of that distribution. That distribution has to go directly from your IRA to a qualified charity. So again, you have to be careful of the institution or the place that you're sending those monies to. But it's a great way. You don't get a tax deduction. However, you don't have to count that distribution as taxable income either. For the year that you do it. So it is a win-win. It's a great thing. But again, speak with your financial advisors, your tax professionals before you do anything like that.
Right. Definitely advanced math. And, this all comes back to strategic tax planning, right? Because as you mentioned, those RMDs are income. And a lot of us assume we're going to be in a lower tax bracket when we retire, but that is just not always the case.
No, I've been doing this for a really long time. And I would say 90 to 95% of the time, that's not the case, that people don't retire in a lower tax bracket. That was kind of a myth that came about in the 70s when we had 20 or 25 different marginal tax rates. Today, we don't have that. Nor do I think it should be a goal for anyone to retire in a lower tax bracket. Retiring in a lower tax bracket means you have less
money,
right? Which means that you're living in a lower standard of
living. I was going to say quality of life, but I'll take that one too. Both answers are correct.
Exactly. You're 100%. So that shouldn't be a goal. I don't think of anybody that you're living in a lesser or lower lifestyle than what you've been planning for, what you've saved and sacrificed for all your working years.
Absolutely. All right, Tommy, this was really helpful to talk through. But again, some of these strategies are a little bit more complicated than others. If somebody has questions about any of the things that we've talked about, what's the best way to reach you?
Give us a call or email us. So our email is tjoconnell@internationalfinancial.com. Phone number 973-394-0623. More than happy to talk through it. Now, it's the beginning of December, so your window of opportunity to make sure you got things done is closing very quickly.
Right.
As a matter of fact, a lot of the institutions want all your paperwork in by December 15th.
Right.
So your window's closing. Make sure you get it done. Avoid that 50% penalty.
Thanks. All right, Tom, thank you very much.
Merry Christmas, Erin.
Yeah, Merry Christmas.
Bye.